Hello and welcome everyone. This is Benham. First, I hope all is well with you, given especially the circumstances we all have endured for the last several months because of COVID-19. Let's hope that the vaccine is not far away and life gets back to normal very soon. Okay, in this video today I'm going to talk about behavioral finance, and you can see in the title it's Behavioral Finance 1, which basically means I am going to provide an introductory lecture on this topic, behavioral finance. In terms of learning objectives, I've got a number of agenda to discuss, including some important elements of CFA syllabus related to behavioral finance. So first, I just want to talk about the contribution of Adam Smith, and you are aware that Adam Smith had written two textbooks. One is Wealth of Nation, and the full title is An Inquiry into the Nature and Cause of Wealth of Nation. But I'm not going to talk about that text today. I want to talk about another text which was written before Wealth of Nation. It's called Theory of Moral Sentiment, and it was written 1759. So it is more than 260 years or even more, but this text still has some relevance and is an important reading also for behavioral finance. If you read this text, some part of this text should be available to read through simple Google search, and what you'll find is this text talks about the fact that people like to be loved. It says people inherently like praise. So I can give you an example here. Let's talk about someone very rich, Bill Gates, who is also a philanthropist. So Bill Gates in a particular day can be in two separate meetings. In one meeting, he will be talking about how Microsoft can increase its revenue, and therefore in that meeting he would be talking everything that is about rational investor. And in another meeting, he may be talking about how he can spend the earnings that he have generated, how he can donate those earnings for the purpose of society or to help a particular community. Why he's engaged in such activity? Because people inherently like to be praised. This basically means people will not be behaving rationally all the time. People will not be self-centric all the time. Mainly because people like to be praised. So this is one reason how we can challenge traditional finance. And given it is a text written such a long time ago, but it still has relevance, I thought I should talk about it. And here you can see the statue of Adam Smith. This is in Edinburgh. The statue itself was erected recently in 2008, and I was there before the statue was erected and after, and when I went there after 2008, I took some photos. And I just thought, why not include some discussion related to Adam Smith? Let us now discuss in relation to behavioral finance, because now it is time that we can define behavioral finance. So basically, as you can see in this Venn diagram, behavioral finance combines psychology and finance together. Behavioral finance is basically, it is about the influence psychology will make on the behavior of investors. So behavioral finance is about the influence of psychology on the behavior of investors. When a large number of people, they follow a particular behavior which is not following the norms of traditional finance, then the market as a whole will be following the path of behavioral finance, and sometimes such an action would lead to market irrationality. Basically, behavioral finance focuses on the fact that investors are not always rational. It also says that investors have limits to their self-control. And basically, behavioral finance is influenced by people's own biases. So you see how behavioral finance contradicts with traditional finance. In case of traditional finance, we say investors are rational and market is also rational. Utility maximization is the sole purpose of the investor. And traditional finance also promotes the fact that people can maintain perfect self-control. And traditional finance also promotes the fact that people are not confused by cognitive errors. However, behavioral finance do not agree with them. In the case of behavioral finance, it is normal for people not to behave rationally. In the case of behavioral finance, people may not be maximizing utility. People will have limit in terms of self-control, and people can make mistakes because of cognitive errors. And cognitive is basically related to, the way we think, we understand, we judge, we provide a solution to problems. Also the way our brain functions, our imagination, our perception, planning, all of them. So basically, in the case of behavioral finance, there is the case of cognitive errors, including people may not be rational, people may not be maximizing utility, and traditional finance, whereas traditional finance says people will be risk averse, behavioral finance doesn't agree to it. So now it's time that we look into some example, and starting with this example, I want to illustrate why people may not behave rationally all the time. So here you can see the black cab, which is also the pride of the nation United Kingdom, because this car is friendly to disabled people. It is also a car that UK exports globally, and now we want to relate this example of cab driving to explain why people may not behave rationally all the time. Let's talk about a cab driver who starts on a busy day, let's say a Saturday, and then assuming everything is opened, pubs are opened. On a Saturday, cabs are pretty much busy, and let's say that the cab driver has already spent 10 hours carrying passengers on this busy day, and after 10 hours he would just check how much he has earned or she has earned if it is a lady driver. And then it will be the case that on a busy day the cab driver has already earned enough to cover the cost of the fuel, already earned enough to pay to the cab owner, and have also made some savings. Now let's talk about a non-busy day such as a Monday. On a Monday, cab driver has already been there in the streets for, let's say, 10 hours, but then the income may not be enough to cover various costs. So then the cab driver would be compelled to drive longer, and it may be the case that the cab driver on a non-busy day will be there in the street for, let's say, 14 hours. So what has happened here? On a busy day, 10 hours finished the day. On a non-busy day, 14 hours or even longer. But if the cab driver is a rational person, then the cab driver should be driving longer on a busy day, that way make more money quickly. But instead what happens is, because the cab driver cannot always be rational, the driver will end up driving long hours in a non-busy day, but shorter hours, or compared to the non-busy day, less number of hours in a busy day. So that's just an example to explain how we may not be resorting to become a rational person all the time. Some other examples here. And now in this example, you can see there is an angry face. What you can do is read the question, pause the video, play the video again. So when you play the video again, you can see the answer, which is, when you see the photo, you can quickly think that this teacher is not happy, so the teacher is going to tell the student, let's say, do not talk in the class, or may ask the student to leave the class. So you can quickly make this judgment that the tutor is unhappy, angry, therefore some action can be taken by the teacher. That's something you can quickly understand. Now let's see another example here. And this time the question is, find out the product of 17 times 24. Pause this video, play this video again once you find the answer. Okay, I'm assuming now that you have played the video again. Of course, you knew that you will be able to find this answer. However, your mind couldn't find the answer very quickly. But in this case, in the case of the angry tutor, you were able to make some kind of forecast about what the tutor is going to do next pretty quick. But whereas here, it took you some time. Of course, you were able to find the answer, which is 408, but you took some time. Now, these are the type of examples behavioral finance people they talk. In fact, these examples are taken from the contribution made by Daniel Kahneman and Amos Tversky in their research. And Daniel Kahneman has this book called Thinking Fast and Slow. This is the example of thinking slow. This is the example of thinking fast. So basically, the way our learning process has been developed. The cognitive process allows us to think of an answer quickly for a situation like this, but slowly in another situation wherein we wanted to find product of some slightly difficult numbers. So because of these reasons, we will be behaving differently, slowly sometimes, and fast some other times. And these examples are just to say that such conditions will have an effect, and such effect can also exist in finance, economics, stock market. Let's give another example, and here in this case I have the question wherein I'm asking you what is the cost of the ball given the total cost of the bat and ball together is £1 and 10 pence, and the bat is £1 more expensive than the ball. So what is now the cost of the bat? So you can pause the video, think about the answer, and play the video again. And majority people, when this question was asked, they found that the answer to this question was the bat was going to cost, the ball was going to cost 10 pence. That was the answer given by majority respondents. And if you have the same answer, do not worry, but let's see here. So when you say the cost of the ball is going to be 10 pence or 10 cents if you are based in America, then what you are saying is 10 pence and the cost of the bat is £1 more than the cost of the ball. So therefore what you are saying is £1 and 10 pence. And that way it is going to be $1.20, £1.20. But that is wrong because it doesn't add up to £1 10 pence. However, if you were to find the answer 5 pence plus £1 and 5 pence, because now here it is £1 more expensive than the cost of the ball, you will get a total of £1 and 10 pence. So that is the correct answer, which basically means 5 pence is the correct cost of the ball to add up to £1 10 pence for the bat and ball taken together, wherein the bat is £1 more expensive than the ball. You see again how the information has been given and how our mind processes the information. Therefore, we can make errors in our judgment. And the same thing can apply in the case of economics, finance, stock market. Therefore, we cannot always be making 100% correct answers. So now what we will do, we will now compare and contrast traditional finance with behavioral finance. And in order to do that, what we will do, we will talk about Bayes Theorem. And in order to understand Bayes Theorem, we will look into the probability quickly, just a refresher to students, and then we will look into the Bayes Theorem. And the reason why we want to look into the Bayes Theorem is the Bayes Theorem basically will suggest us about the probability given we are aware of certain outcome. So basically we want to apply Bayes theorem, and with the help of Bayes theorem we'll be able to say what we need to do given something is known. So then this basically means if something is known, then according to traditional finance theory, we need to revise our expectation. So that's what we want to see. But first thing first, how can we compute probability? So here we want to understand what is the probability of drawing 2 kings from a pack of 52 cards. So that's easy because there will be 4 kings in a pack of 52 cards, and if you are drawing randomly, then you know that there are 4 kings out of 52, so the unconditional event probability of obtaining the first king will therefore be 4 over 52. And that's easy to understand. Now that you have already found this probability of first king, now the second time you want to draw the king, you know that there is now only 3 king left and 51 cards left. So this basically means you have some prior knowledge now, which is probability that the next card is going to be the king. That's what you are trying to find out. Probability that the next card is again going to be the king, given you have already found the king with a spade. Yeah, king with a spade. So that's what you are trying to find out, and that will be basically equal to 3 over 51. Now in the case of joint probability, which is probability that the first card is a king and also the second card is also a king, of course with the different colors, then this will be equal to the unconditional probability, which is here, times the conditional probability, which is here. Therefore 4 by 52 times 3 by 51, and therefore you get this answer. So that was easy, but important part here that I want you to remember is this particular formula that we applied to find out the joint probability of A and B. Now this basically means if you have understood this, then you can put this part in one side, then this will go as denominator. So that's what exactly I have done here. Probability A and B, this part I've taken on this side and it looks like this. Now what we can do here, we can just replace A with B and B with A, which basically means I am changing the situation here in which what I'm saying is probability of A given B is known. And again, it's simple, similar to this, it's just on the denominator I need to change probability of B. Now this we can write in this format. It is same as this. A and B is replaced by probability A intersect B, as in the case of Venn diagram, but actually no difference at all. If you wanted, you could leave it as it is as well. But here we're deriving the formula for Bayes theorem, so you can see there is something similar. This is similar, this is similar. So we can take advantage of the similar item in the numerator now. Okay, so basically what we can therefore do is we can say that the probability of this and this is here. So this and this will be equal to probability A intersect B. So that's something we have converted here, this whole bit. Okay, but then you see the fact that this particular item is same here, so this means this whole can be equal to the product of these. That's what I have kept here. So therefore now what you can say is probability AB, this item here, when you take this item here, then the remainder here is this exactly divided by probability B, which is here. And that's basically the derivation of Bayes theorem. Of course, when it is probability B, it can be expanded because this will be simply equal to the all of it here and the other areas captured. And this is something easy to understand when we show you with the help of an example. Of course, Bayes theorem, the credit goes to Thomas Bayes, who developed this theorem long time ago. So let's look into this numerical example, and what you can do is you can pause this video, think about the answer, and play the video again. Let me complete the scenario, the information related to scenario here. Here we are saying that we will buy the stock. So buy. And here we are saying we will not buy, or do not buy, or buy less. Okay, whatever is easy for you. And here we are saying bull. So basically, let's think of a scenario. We are starting here and we are saying that, all right, if COVID-19 vaccine is there, then people will be optimistic and therefore they'll be more active within the economy, and therefore they'll be buying more stocks. So this is just an example, okay? Therefore they'll be buying more stocks. Buying more stocks means stock market will become more active, therefore there will be a bullish trend. So the market will become bullish. And if they're not buying, then it will be a more bearish, little bullish. Here, high bullish 90% with a small probability of bearish market 10%. Now the question here is, what is the probability? The question that I'm asking is, what is the probability that people will buy the stock given the market is bullish? Okay, so this is the question, and I want you to apply the Bayes theorem that I've just discussed here, the formula that we derived, and find out the probability. Okay, so you can pause the video now and find out this probability. So now what you can do, I'm assuming that you paused and played the video again, so I'm continuing my discussion. Here is probability of buying. It's an unconditional probability, so we can say probability of buy here is 80%. This 90% here is conditional, because here what you are saying is probability of buying given the market is bullish. So let's talk about this situation here, and in terms of probability, what we are saying is probability that this is going to be a joint probability, isn't it? Joint probability of the market is bull and buy. Bull and buy. What is this? So this is a joint probability, and in this case what we can say is this will be equal to probability of the market being bull, given we are already aware that that people are buying, times probability, the unconditional one, which is buy. That's what you can say. So over here in these four outcomes, you can see that only this outcome is fulfilling this criteria. Therefore, what you can say is this will be equal to bull and buy 90% times 80%. Therefore, you get 72% answer here. So you can do the same. 80 times 10 is 8%. And here 20 times 3 is 6%. Here 7 times 2 is 14%. So that altogether this will be equal to 100%. But so we found the joint probability, we know the unconditional probability, we know here we're talking about conditional probability, and the question we're asking is, what is the probability that people will buy when they are already aware that the market is bullish? So you can see where the market is bullish. In this outcome here, the market is bullish, and in this outcome here, the market is bullish. Okay, so now in order to find the answer for this, you can basically write the formula first if you wanted to, which is the formula will be probability that the market is bull, condition that the people are already buying, times probability that people are buying, and then divided by the probability of bull. So probability of bull. Now this probability of bull, if you see in the formula above, is capturing the same item in the numerator here, and this again looks the same. Now in the case of here, therefore what you need to do, the same item as here above, which is 80% and 90%, plus the another outcome which is again giving you bull, which is 20% and 30%. So therefore what you can do is, this is basically already found, which is 72%, and it is divided by bull, again that's 72%, plus in the formula here that's 72%, and this one now another outcome suggesting the bull, which is 20% and 30%, 6%, and therefore you will get 72% divided by 78%. And that should give you, it is less than 1, so somewhere around maybe 90% or so, okay? Or we can do the calculation if you want to find out the exact answer, which I can do in Excel. And let me open Excel here, or maybe I can find calculator, calculator. So that's basically 72 divided by 78. So 72 divided by 78, and that's going to give me 92. Well, I was not very far away, and therefore the answer is going to be 92%. Okay, so what have we done? What we have done is we have revised this probability. Given we are aware that market is going to be bullish, the probability of buy is now not 80% but 92%. So this is using Bayes Theorem, and that's what rational investors, the traditional theory, allows us, promotes us to do. Okay, and that's what we have completed the example. So we have acted as a traditional as per the traditional finance. Now the question is this: using the Bayes theorem, what we do? We revise existing prediction. Okay, because the theory has given new or additional evidence. So given this new evidence that the market will be bullish, we now have a new information that there is a probability of 92%, let's say, buy order, or 92% people buying the stocks. So we revise this 80% to 92%. So something similar we learned in efficient market hypothesis as well. Given there is a new news, i.e. something similar to the fact that now that we are aware market is going to be bullish, there is a new news, then what happens? The share price will move to its new equilibrium when there is a new news. So exactly similar scenario, and this is what we are saying. The theory is telling us, advising us to revise our expectation, because now this is not equal to 80% but 92%. But the center question here is how many of us will be revising our investment decision based on the conditional probability of an event. This is what traditional finance suggests us, but how many of us will be doing it? Now, there is an interesting reading about this, and that's something I would like to find and show you, and that is something I will be able to find in Financial Times. And I believe you have free subscription to Financial Times. I think I am already logged in, so I should be able to find this article that I want to show you, diversification. And then in diversification, I need to filter and find out, because I know the date it was published, relevance, refine your search, and I can say here 21st of August 2009, and again here 21st August 2009. And we apply it, and then you should be able to see that, yeah, that's the one. So I'm clicking it, and then you can see that it is talking about the same concept that I asked, which is how many of us will be following the recommendation of traditional finance. So what this article say is, let's ask this question to people who are in fact those who have created these theories, such as Harry Markowitz. And then you will see here is Professor Markowitz at a conference in Chicago on what he invested in. I should have computed covariances of asset classes and drawn an efficient frontier. Instead, I split my contribution 50-50 between bonds and equities. So this then basically means there is no chance that Harry Markowitz will be revising the expectation, something similar to what we saw here when we applied Bayes' theorem. Instead, just making the life easy, 50-50 between bonds and equities. What about William Sharpe? And what William Sharpe says is, I invest in funds, large stocks, small stocks, and international stocks. This then basically means William Sharpe is to some extent applying the diversification theory, but then William Sharpe is highly likely not to be revising, rebalancing the portfolio. And let's see what Eugen Fama does. When asked by a publication called Investment News what he invested in, he replied by detailing a fund invested in the broad-based U.S. Wilshire 5000 index plus small cap and international index fund, and just over a third in value-oriented stock indices and short-term bonds. Of course, there is ample evidence of diversification, but then again, they are not going to do anything beyond that. That is basically suggesting the fact that even the promoters of traditional finance are not applying what they are promoting. Hence, behavioral finance imposes a challenge to traditional finance theories. And here I have photographs of Nobel Prize winner in economics. All these people here in this slide have won Nobel Prize. For example, Eugen Fama is here, who had shared the Nobel Prize with Robert Shiller, and another person who is not in the photo, Peter. And then we've got William Sharpe, his contribution related to Sharpe ratio and CAPM. We've got Modigliani, Franco Modigliani, Merton Miller, and capital structure theories, their contribution. We've got James Tobin here, who is the promoter of the separation theorem, and Harry Markowitz, who has developed the efficient frontier line. And we saw in this reading how they are managing their own portfolio when it comes to investment. So this in fact imposes a big challenge to the rational thoughts. And to talk on the same line, I have this very interesting case of 19 October 1987, which is also known as Black Monday. Let us now talk about some stock market crash, particularly 1987, the 19th October 1987, also known as Black Monday. And this day records the highest drop in Dow Jones Industrial Average, 508 points. And then many people since then have tried to explore on the causes of this particular stock market crash that started from Hong Kong. Now, in reality, there is no consensus among people in regards to what exactly caused this very big market crash. Of course, there are reasons that have been given, such as formula trading and market structure may have combined to allow the crash. But to say that such a big drop in the value took place just because of a particular reason, such as formula trading, is still something not easy to digest. What Robert Siller did, of course, Eugene Fama also aimed to explore on the causes, but Robert Siller, he sent out questionnaire to relevant people, and the finding was that there was psychology, which was an important factor to play a role in this stock's plunge. So you see that it's hard to provide a reason to a crash of this scale using traditional finance theory. So this again challenges the traditional finance. Now let us look into traditional finance perspective on individual behavior. Of course, people need to be rational. There is utility theory. People should be revising expectation according to Bayes Theorem. And investors, they are there to maximize utility because that is related to happiness. And there are four axioms that are important, and they are completeness, transitivity, independence, and continuity. And these four axioms are also important questions in the professional body exams such as CFA. So I'm going to take a small time to explain about this. Here, when you are saying completeness, what you're saying is you like stock A over B, or we can say you like B, which is brownie, let's say, over cookies. That's completeness. You have clear idea what you want over what, and that's complete. That's completeness. Brownie over cookies. When we say transitivity, what we are saying here is you like brownie over cookies and you like cookies over, let's say, milk, then this basically means you like brownie over milk. So that's again important for traditional finance. Now, independence basically means you like brownies and you like cookies. Now, you add some milk here as well. So now you cannot say that you like cookies with milk more than brownies with milk. So according to traditional finance, it is still the case that brownie plus milk will give you higher utility compared to cookies plus milk. And the continuity is simply saying to you that there are indifference curves. Utility theory gives us indifference curve, and we've got the risk and return with the risk on this side, horizontal axis, return here. But what we are saying here is utility 1, utility 2, utility 2 provides higher satisfaction to the investor, and what it also says, the continuity basically means there can be infinite points in utility curve, the indifference curve, and at any point in this curve, the satisfaction, the utility derived is going to be the same. That's about continuity. So I just thought this can be a good example to help you remember the 4 axioms. If you think of brownie and cookies, of course you can relate it with stocks as well. And if you're relating it with stocks, of course you're saying you like stock A over B. So you like A more than B. Here you are saying you like A more than B. You like B more than C. Therefore, it is the case that you like A over C. And you can just say here that there's stock A plus a dividend 10 pence, and then here you've got stock B plus dividend 10 pence. Then basically you will the utility given by here is higher than utility available here. Okay, and continuity is the same, that at the continuous utility in the indifference curve at any point will be the same. But the behavioral finance, challenges all these assumptions we have made, and that should make sense given the type of example that I just illustrated. Now we want to link the relationship between utility and wealth and link it with different types of investors, because we now want to talk about an important theory called prospect theory. And just before talking about the prospect theory, it is very useful that we link utility and wealth with the nature of the risk aversion that people maintain. So here we just want to understand which particular graph is for which type of people. So risk loving, so let's start with the easy one, the risk neutral people who will have constant marginal utility of wealth, which means wealth increases by certain percent and the utility increases exactly the same in same proportion. That's risk neutral, has constant marginal utility of wealth. So that's easy to understand, hence we can say this is risk neutral. Now let's look into this diagram. What is happening here is as wealth increases, the utility also increases, and here utility is increasing quickly. Okay, that's what we can see in the graph. But after this point you can see the increase in wealth is high here, as compared to the increase in utility. So this basically means has a diminishing marginal utility of wealth. Therefore, this diagram belongs to risk-averse people, and that's what you will see traditional finance promotes, that people should be risk-averse. Now let's look into this, because this is the third. You can easily make a guess that this belongs to risk-loving people, so that's risk-loving, and the curve here is concave, but here is convex to the origin, and what it's simply saying to you is as wealth increases, utility goes off significantly, and that's what we can see with the help of this type of diagram. Even with a small amount of increase in the wealth, utility goes off very high. So just to compare this risk averse utility wealth graph with risk loving utility wealth graph, what we can say is if someone has a wealth of, let's say, 100,000 and the wealth increases by £10, and here for a risk averse person 100,000 and the wealth increases by same £10, here the utility will be very very low, but here the utility can be high, because any amount of increase in wealth, the utility for the risk loving people goes up. Now with this understanding, we can now build our knowledge on the prospect theory, and this is a theory developed by Daniel Kahneman along with Amos Tversky in this paper, an analysis of decision under risk, and I highly recommend that you read this paper, hence the reason why I have provided the citation here. And if you click this link here on the photograph, it will take you to the video where Daniel Kahneman is describing his finding, and this is a video which has a length about 45 minutes, 3/4 of an hour, which basically means I will not be able to play it here in this discussion, but when you get time, please have a look, and this is interesting and provides you some good knowledge as well. Of course, you may be able to find some other videos from Daniel Kahneman that can equally be interesting. But many students, they ask me what exactly is prospect theory, and this is my answer to them, and my answer to them is PHLMMTTLW. What does this mean? This basically means people hate losing much more than they love winning. So what does this mean? We dislike losing more than we like winning. Again, we dislike losing more than we like winning. So that's something I can write here, which is we dislike losing more than we like winning. And in the word of Kahneman, this is what they say, which is people hate losing much more than they love winning. And that is the main center idea behind prospect theory. When you read the term prospect, it can mean a number of things, but this is the main foundation of prospect theory. The name here is taken from, the lottery wealth, mainly the lottery, but that's how the term originated. But this is the main foundation of prospect theory, and we have some examples here to illustrate, and this is in fact the exact survey question that Kahneman sent out to a large number of people, including university students, and in this survey question, it's like tossing a coin, and tail basically means lose and head means a win. And if you get a tail, let's say you will lose $10 or £10, and if you then get a head, what would you like to have as the value of getting ahead in your betting? So what should be the value of the bet if it is a head, provided if it is a tail you will lose £10? So what you can do, in fact, you can pause this video, think about the answer. If you get the head after losing £10 in the first bet, what is that you would expect as the win from the next tossing of the coin if it is a head? So pause the video, think about the answer, play the video again, and now I'm assuming that you've already thought about the answer, and this question was asked to a large number of people, and on average the answer was between $20 and $30. So 20 here and 30 here. Okay, so that basically means people hate losing much more than they love winning. They are not asking to just to get back the same amount that they have lost, because the pain of losing is much more higher than the joy of winning. And that's something we can illustrate here diagrammatically as well. Here in this quadrant you have the risk averse person, okay, and here what will happen is you'll be risk seeking in nature, and therefore you can see this is concave, the graph, whereas this is convex. And that's something we can illustrate using this case. So again, you can think of the answer, pause the video, play again. Firstly, what is it about? It's about the fact that you bought some shares last year and the value went up. As a result, you gained $200. How do you feel when you make £200 from your stock investment? You feel good. You feel good about it, don't you? So I've given you the answer for the first part. How do you feel? You feel happy that you gained some money. Now, second question, by how much your utility went up. Pause the video, play the video again once you found your answer about the second part, which is by how much your utility went up. If you just relate it in terms of value, then simply speaking, we can say the utility in terms of value went up by, let's say, $200 or pound. So that's your answer. Let's not think too much. It's simple, isn't it? But let's see case number 2, again asking the same question, but this time this is saying you lost the value. How much you lost? Exactly the same amount, $200 pound again. How do you feel? Of course, you don't feel good. You're unhappy by how much the utility went down. Again, you can say from the same logic, $200 is what you lost. So this then basically means case 1 200, case 2 200. So therefore we can say case 1 and case 2 amount is 200. The positive utility here and the negative utility here should tally. Isn't it? What do you think? Pause the video, play the video again, and you will see in the answer this diagram. What this diagram is saying here is the gain here is 200 pound. The loss here is also 200 pound. So the distance here to here and distance here to here is equal because they both are representing the same 200. One side is a gain and the other side is a loss. But can you see here the joy of the gain is just here, but the pain of the loss, can you see this is much more bigger than over here. So that is what this paper also found. Koval and Sumway also found the same finding. And therefore I recommend that you read this paper. And this paper basically says that traders who were losing in the morning session, they were behaving as gambler in the afternoon session in order to make up for the amount that they have lost. They were trading but like a gambler. All right, so that is an interesting case to discuss. So let's continue the discussion, and we're talking about the pain of losing will be higher in magnitude as compared to the joy of gaining. Hence the reason why we said in this paper something interesting in terms of how the traders behave in their afternoon trading, given they made a loss in the morning session. Basically, they behave as gamblers in order, in the pursuit to make up for the losses that happened during the morning. Hence, this is an interesting reading for you. Now we want to provide some reasoning in relation to the behavioral issues. Basically, we want to talk about the errors that take place because of various reasons. And the first reason here is forecasting errors. Now, forecasting error is basically related to the fact that people overweight the belief from their recent experience. So they take in their belief recent experience, the weightage of recent experience is much more higher. And in this relation, what we can say as an example is, let's say, price earning ratio. So the price earning ratio of the firms which are higher are then considered by the investors in their investment. And that's one of the reasons why firms having a high price earning ratio doesn't always win. And what happens subsequently, people revise the price earning ratio and therefore they bring it down. So basically people overweighting the or giving overemphasis on the to the recent experience compared to prior beliefs when making forecast, and they tend to make forecasts that are too extreme given the uncertainty inherent in their information. So that's forecasting errors. And the second point here, which is overconfidence, is basically the fact that people tend to overestimate the precision of their beliefs or forecast, and they tend to overestimate their abilities. Now, there is a very interesting research. It's about the drivers in Sweden drivers, and 90% of drivers in Sweden ranked themselves as better than average drivers. Now, mathematically speaking, this is not possible. 90% of the drivers saying they are better than the average. So that's mathematically wrong. This basically means there can be errors because of overconfidence. So that is interesting in itself. And here on this table, you can see the overconfidence in terms of behavior among men and women. And this is something again interesting, and I would recommend you to read a paper by Barber and Odian. So here an interesting paper by Barber and Odeon 2001. In fact, I will show you this paper. I should be able to find using Google search, which is, but let me go to the Google Scholar. Google Scholar, and then within Google Scholar I can type, but yeah, Barbara and Odeon, I had seen it before, so that's an interesting title. It say boys will be boys, gender, overconfidence, and common stock investment. An interesting reading wherein you'll find men, they are overconfident as compared to women in the investment aspect. And this is so interesting. Trading too often, men 12, ladies only 5. You see, waiting too long to sell a winner, 43, 28. So all these numbers are interesting, and I highly recommend the article by Barber and Odeon for your reading, where you will be able to find those interesting findings. And the third one here we have is conservatism. Now, basically, conservatism bias means that investors are too slow in updating their beliefs in response to new evidence. So basically, this is arguing the efficient market hypothesis. According to efficient market hypothesis, the price will move to new equilibrium immediately after the news announcement. But what conservatism says is, in fact, people may take longer to respond to new evidence. This basically means that people might initially underreact to news about firm, so that prices will fully reflect new information only gradually, not quickly. So what will happen then? Such a bias will basically give rise to momentum in stock market returns. That's conservatism. And finally, we have sample size neglect and representativeness. What this basically means is people are here on this one. What we're saying is people are too prone to believe that a small sample is representative of a broad population and infer patterns too quickly. So the result derived from such small size may not be significant, doesn't involve the majority of the population or the required number of sample to represent the population. And if we make a decision based on such small sample as a representative of the population, then we will be making error. So that is sample size neglect and representativeness. So what you've seen in these is the fact that because of these reasons we will be making errors, because they are the biases in our information processing directly relevant to investment decisions. What we will do next, we will look into some behavioral biases. Let me assure you that in my next lecture, we will be looking into a number of important behavioral biases and irrationalities. But here we want to talk about some of the important behavioral biases which also make a major impact on our investment decision. So let's start with number one, which is framing. And in terms of framing, I will show you the the exact survey that was conducted by Slobik et al., and this is it. They sent this particular statement in their survey. So this is asking you the question, do you prefer a sure loss of $50? So sure loss of 50 is an option, or a 25% chance to lose $200. So in this case, the way the information is framed, what will be the answer? You can pause the video and play the video again after thinking of the answer, and the answer, as you will see, you will find that the majority respondents would not like the sure loss of $50. They would in fact be willing to gamble, i.e. to take 25% chance to lose 200, and the response that was received was 80% in favor of 25% chance to lose 200, as shown here. Now the next box will show you some things similar. So take your time to read this. Think of the answer, think of the choice that you will take, pause the video and play it again. I'm assuming you have already now paused, thought about the answer, played the video again. So this time it is saying, would you pay $50 insurance to cover a 25% risk of losing 200? Mathematically, look here, 25% chance to lose 200, 25% risk of losing 200. So that's again, mathematically is 25% times 200, same 50, 25% times 200, same 50 again. So there's no difference at all. But you will see here the way the information is framed. Insurance, of course, this is a sure loss. $50 insurance is also a sure loss, so this answer is also same. So what we can therefore but the way it is framed makes a big difference, which is, you can see here, the answer that was found is people are happy to cover, to avoid the loss by paying $50, because there are terms such as insurance to cover a risk of losing 200. However, in essence, both the choices here are giving exact same numeric outcome. So that's framing and a good example. In fact, I will next provide you another example in relation to this framing, and which is something I will write using the pen. So give me a second. So now in my second example related to framing, as I said, I'll be using pen and paper and the whiteboard to explain, because that way I believe it is going to be easier for you to understand. So I'm now going to set out some choices. Let's start by saying that you have choice A, in which you have the option which is there is 2/3 chance, or 66.67% chance that you will win nothing, zero, but 1/3 or 33.33% chance that you will win 6,000. Now you need to choose between A and B, and the B being there is, let's say, 80% chance that you will win nothing, but 20% chance that you will win 11,000. So now if you were to find, because they are, let's say, mutually exclusive, therefore you need to take either A or B, which option will you take? So that's question number 1. So pause the video, play it again. Now I'm assuming that you paused and you're playing it again because you already have the answer. And in this case, the answer you will find is simple, because here the weighted average will be equal to 0 times 66.67% plus 33.33% times 6,000. Basically that will give you 6 threes this is 0, here you'll get 2000, so therefore 2000 as your answer. And in this case again, 80% times 0, so 0 times 80% plus, in this case here you will get 20% times 11,000. So you all hopefully were able to find 2,200. Therefore you said, I will prefer choice B over A. Therefore B is correct. Now I'm going to set out another set of information, which is the fact that you are given the choice to play the game, but there is a probability 66.67% that you will not be allowed to play the game, which means you got 1/3 or 33.33% probability that you will be allowed to enter into this game. So if you're not allowed, you don't need to do anything further. But if you're allowed, if you fall in this 33%, then let us create 2 separate scenarios. Then we're just talking about you can play 2 games and you can take either one of the 2. And the first game is basically saying you have a guaranteed my pen is guaranteed win of 6,000. Okay, that is guaranteed. So basically that means you have here 100% probability to win this, isn't it? Or you have the second choice, which is you can win 60% of let's say 11,000. So therefore now you need to make a decision whether at this point you will take, let's say, this choice which is C or this choice which is D. So that's question number 2. In between choice C and D, which option would you take? So what you can do now, you can pause this video, think about the answer, and play the video again. I'm assuming you've already paused and you're playing it again to match your answer with the one that I'm going to show you next. So here, in the case of choice C, what do we understand? That's 33.33%. that if you are allowed to play, then there is a guaranteed win of 100%. So that's 100%, and that basically will give you that 33.33%, and the guarantee to win therefore is 6,000, and basically that will give you this answer, which is 2,000. So basically, when this question is asked, a majority people here would say choice C would be my preference because I want this assured win of 6,000. But now let's see what outcome do we get for choice D. In case of choice D, that's again 33.33%. and multiply by not 100 but this 60% here, which is 60%, that will give you 6 3 to 18, 18, and that will be 20%, and then 20% times 11,000, hence you get 2,200. So in other words, there was no difference in the outcome between choice A and B and choice C and D, but look at the way the information given was framed. Therefore, we made the error in our decision, because when this question was sent out, majority people, they said they would like to have this guaranteed win of 6,000. So that's how we can illustrate the framing error. So let's go back to our lecture slide, and now we can talk about the mental accounting. So basically now on this mental accounting, what we can say is it is a specific form of framing in which people segregate certain decisions. For example, you may have inherited property from your parents, and assuming the property price is very high, as a rational investor, you should be selling that property now because the gain will be substantial. However, because of your attachment with the property, you may decide not to sell it, because the property may remind you of your of the people who gave you that property. Okay, or you can think in terms of the tuition fees money that you have put aside for your children's education. So therefore, what you will do, you will not invest that money in the stock market. You'll keep that money safe, although it may be the case that if you were to invest in financial securities, you would have made higher income. But you see, you have in a way framed in your mind that this money is not something that you can play with. So rationally, however, it might be better to view the fact that investors' overall portfolio with a risk return profile would give you better reward if you were able to use that money and invest, but you would not do so. So that's mental accounting. And finally here we've got regret avoidance, and of course read the paper by Sefrin and Statman 1985 for mental accounting. Good illustration here, also published in Journal of Finance. And finally we've got regret avoidance, and as an example I have listed some companies. Now if you see the name of the companies here, you will be able to make some forecast regarding these companies, which are in fact well established companies that have good fundamentals, so you can call them blue chip stocks. Okay, so what you are then saying is you made, before the investment, you made proper research of these blue chip companies, and assuming you found all the fundamentals working really well, and you also did some other possible research, and then you invested. But unfortunately, let's assume that you lost the money. How do you feel? You and in another case, you just found a company, you didn't know much about the company, you didn't do any research, and then you invested and then you lost, the pain you will suffer from the second investment in which you didn't do adequate research will be higher. But in this case, the regret avoidance basically means, in the case of the blue chip company investment where you had undertaken proper research, the regret avoidance will be lower, and or you will regret less. Okay. um, and and we can also relate it to a research by De Bont and Thaler, Richard Thaler, 1987, and they argue that such regret avoidance is consistent with both the size and book to market effect. Higher book to market firms tend to have depressed stock prices, and these firms are out of favor and more likely to be in a financially precarious position. Similarly, smaller, less well-known firms are also less conventional investments. Such firms require more courage on the part of the investor, which increases the required rate of return. So that's an interesting finding by De Bont and Thaler, 1987, and I can show you that paper quickly. I just need to type the name, and the name is De Bont and Thaler, 1987. I hope further evidence on investor overreaction and stock market seasonality, and that's something I can capture the reference and put here for your information. So there you go, something I have missed out to keep for your reading. Now it is here, which you can find. But that's basically regret avoidance, in which what we are saying is any losses on the blue chip stocks can be more easily attributed to bad luck rather than bad decision making, and therefore they can cause less regret as compared to buying an unknown startup firm and therefore losing the money. Okay, so just three behavioral biases we talk, but they are directly relevant to the type of investment we talk about. And now, as the final piece of word, I have this to say to you. And this is interesting because you can see in the diagram, and here I have some alphabets, E, T, W, T, R, D. So basically, what this means is emotional tails wags the rational dog. Emotional tails wag the rational dog. So this basically is to suggest the idea that, number one, it's difficult to be rational, and number two, the emotion that we find within the scope of behavioral finance is important, and the rational decision is not something always possible. And in the end, I have some other reading list which I have not captured here in the slides, so I hope that you will find them useful too. So overall, we captured a number of concepts. We also discussed about prospect theory. We challenged traditional finance. We also explained the conditions of traditional finance, risk aversion, higher utility, and we also said the rational investors need to revise their expectation based on new conditions. And we also talked about cognitive errors that in the case of traditional finance is not there, but behavioral finance says the way we process information, knowledge, problem solving, they maintain an important influence in our decision, hence they are important. I also want you to spend some time researching about the causes of this October 19th, 1987 stock market crashes. You'll find it through Google search, something very interesting, because the cause of the market crash is not rational, not coming from traditional finance. It's more to do with behavioral finance, and therefore we said the traditional finance has been challenged in a number of ways by the behavioral finance arguments. So this was what we discussed, and we also provided some example. So I now want to conclude my introductory lecture on behavioral finance. Thank you very much for your time, and thank you very much for listening. Thank you.